Hi, how are you? Welcome back to my YouTube channel. My name is Brian Yakwaka. I'm a financial analyst and a full-time forex trader. So today I'm just going to give you an overall talk concerning forex. I know a lot of you have questions concerning what happens there and how people make profits and how you come about losing money. Forex is real. Forex is not a gambling site. Forex is a financial market whereby you anticipate whether one currency is going to increase in value than the other. And when a speculation becomes right, you make a profit from it. When a speculation is out of the box or your speculation is wrong, you make a loss. So that's how Forex traders make money. It's not a gambling site. And for you to be in a position to know what is going to happen in the near future, you should be in a position to analyze the market and get to know that in the near future, the price is going to be at this position. In the near future, the price is going to be, it's going to either to drop or go up, or it's going to be in a ranging mode. You should be in a position. That brings us to different types of analysis. We are going to talk about that. We are going to talk about different types of currencies. We are going to talk about different kinds of currency pairs. We are going to talk about how you should be in a position to analyze the market using trend lines. We have trend channels. We have support resistance. We have things like indicators that that helps you find the areas of confluence for you to enter your trades, and also going to teach you how to take your profits and stop your losses, and how also to manage your risk. And also I'm going to give you some of the mistakes that a lot of beginner traders make that make them lose a lot of money and discourage them from trading. So welcome. In case you're new here, don't forget to subscribe and smash for me that notification bell to get notified every moment I'll be dropping a new video. Thank you. So guys, Forex is a financial market. Forex in full means foreign exchange of one currency for another. And we have different types of currencies that are being traded in Forex. We have major currencies, minor currencies, and exotic currencies. So major currencies, they are 7 in numbers. The reason why they're being called major currencies is because they're very, very volatile in the financial market. They're very, very sensitive to market emotions, to market fundamentals. So they are 7 in numbers. We have United States dollar, we have euro, we have Canadian dollar, we have Great Britain pound, we have Swiss franc, we have Japanese yen, and we have Australian dollar. Any other currency apart from these 7 currencies, they are minor currencies. And exotic currencies are currencies from third world economies. These are currencies from third world economy. For example, we have South Sudan dollar and Zimbabwean dollar. When you go to the financial market, you'll find that currencies are being traded in pairs. The reason why they're being traded in pairs is because you're simultaneously buying one currency and selling the other, or you're simultaneously selling one currency and buying the other currency. For example, we have United States dollars / euros, Great Britain pound / Japanese yen, Swiss franc / Australian dollar, like that. You cannot trade one currency for itself. So let's say, for example, you've traveled from one country to another, you've gone to a new country, you'd be forced to find an exchange booth for you to be able to exchange your local currency to that currency of that particular nation. And that way, things have been broken down and given you easy access to the market for you to be able to exchange your currencies. You can easily trade the currencies in the financial market. So for you to get access to the financial market, all you just need is a phone, laptop, any other gadget that has access to internet. So that way you'll get access to the financial market. So financial market is very, very huge, and it's being controlled by large institutions, and that you as an individual cannot easily control what happens there. And how do people make money in financial market? You make money by speculating whether one currency is going to increase in value than the other. And when speculation becomes right, you make a profit from it. When speculation becomes wrong, you make a loss. So that way, you have to analyze the market properly and get to know what is going to happen in the near future in that currency. So that brings us to three types of analysis. We have fundamental analysis, we have technical analysis, and we have sentiment analysis. I'm not going to talk about sentiment analysis because it's not that important in Forex. We have fundamental analysis. Fundamental analysis is the study of political, geopolitical, socio-political factors that affect currencies. Things like we have interest rate, mortgage equity withdrawal, we have a consumer price index, like that. These are fundamental factors that affect the price movements in the chart. And fundamental analysis is very, very important because this is what moves the chart. When you go to when you go to your MetaTrader for any platform that you're using, you'll see the market moving. So the things that make the market move, these are the fundamental factors. Technical analysis is basically the study of prices in the chart. You study what happens in the chart, and you study what happens in the chart. You put your indicators, you put your trend lines, support and resistance, look at the candlestick anatomies, you look at what kind of pressure in the market, you look what trend the market is taking, you look at several factors in the market. The moment you study the market and you study the chart, you'll be called a chartist. You study the chart and you tell that in the near future the currency is going to be on a buying trend, the market is going to be on a selling trend, the market is going to be on a ranging mode. So that way you'll be called a chartist. So that brings us to different types of currency pairs. That have major currency pairs and minor currency pairs. Major currency pair, these are currencies that are paired to United States dollars. Minor currency pair, these are currencies that are not paired to United States dollars. The reason why when you pair any currency to United States dollar is called a major currency pair, we're going to see. So that brings us to why a United States dollar is a leading currency. In technical analysis, that's where I'm going to put more of my effort, because that's where a lot of traders, both beginner traders and a lot of experts, use to analyze the market and be in a position to tell that this kind of market is going to be on a buying trend, is going to be on a bullish trend. So technical analysis, just like I told you before, is the study of price movements in the chart. And that brings us to three different types of charts in technical analysis. We have candlestick chart, we have bar chart, and you have line chart. Candlestick chart is very, very important because it portrays what kind of pressure that is the market. Line chart only portrays the closing prices that have been joined by a line to form the candlestick chart. Bar chart is not that important. So I'm going to dwell more of my efforts on candlestick chart and the line chart, because line chart, when you close, these are called closing prices that are joined by a line. They can easily tell us what direction the market is going at. You can easily draw your trend line. You can easily locate your support and resistance. So it's very, very important. Remember, candlestick has got two main parts. We have the body and we have the wick. The body portrays the kind of price that is the market. Wick only tells us at what point the price reached. At what point did the price reach during that tug of war between buyers and sellers? So in both bearish and bullish candlestick, the highs and the lows are constant. The only thing that differentiates these two is the opening and the closing points in a time frame. And you have different types of time frames. You have 1 minute time frame, 5 minutes time frame, 15 minutes, 30 minutes, 1 hour, 4 hours. We have 1 day, we have 1 week, we have 1 month. There are those that go to 1 year. So it depends with the type of a trader. It depends with what type of a trader are you. So if you are an intraday trader, you would take 4 hours trade or one day. All time frames are very, very important, because you have to analyze different time frames, starting from higher time frame to a lower time frame, and you have to see if what you're seeing is consistent from a higher time frame to a lower time frame, starting from day one, from a day time frame, 4 hours time frame, 1 hour. When you look at the candlesticks and you see that the market is on an uptrend and it's consistent from of 4 hours to 1 minute, that is very, very important that you'll be in a position to execute your orders. So that brings us to activities that happen there. We have bearers and we have bulls. So bears and bulls emanated from how bulls and bears normally fight. The moment you hear bulls in the market, the moment you hear bears in the market, you should be in a position to know what direction the market is taking. So bulls just emanated from how bulls normally fight. Bulls fight by thrusting their enemies into the air. So the moment you hear the market is on a bullish trend, know that the market is on an uptrend. Bears normally fight by dragging their enemies onto the ground. So the moment you hear bearish trend, the market is on a bearish trend, know that the market is on a downtrend. And you have ranging trend and you have choppy trend. Choppy trend is that which doesn't have choppy trend is that doesn't have a clear direction. You cannot trade that kind of a market. Choppy trend, ranging trend, it moves horizontally going to the right. It goes to a support, to a resistance. It goes to a resistance and support, resistance and support. It doesn't tell you whether the market is on an uptrend or a downtrend.